Somewhere out there right now is a careful, sensible retiree. Let's say she did everything right her whole life, and she has $200,000 sitting in her savings account at the big bank down the street. And she feels good about it. Safe. Prudent. That money can't crash, can't disappear. It's right there whenever she needs it. She sleeps well because of it. And here's the uncomfortable truth I have to tell her, and maybe you. That pile of cash, sitting there feeling so safe, is quietly costing her thousands of dollars every single year. It is shrinking right now, even though the number on the statement never goes down. She's making a real and expensive mistake, and it's disguised as the responsible thing to do. That's what makes it so dangerous. Nobody warns you about the mistake of being too safe. So today we're going to answer a question that sounds simple, but trips up almost everyone. How much cash should a retiree actually keep in the bank? And I want to be honest with you from the very start, because this cuts in two directions. Keeping too little cash is a serious mistake. It can force you to sell your investments at the worst possible moment and genuinely wreck your retirement. But keeping too much cash is also a mistake, a quieter one that slowly bleeds away your money's power year after year while you feel perfectly safe. There's a right amount, a sweet spot, and most people are sitting on the wrong side of it, usually with far too much. By the end of this video, you'll know exactly how to calculate your own right number, how much belongs in the bank, and not a dollar more. I'll show you where the rest should go so it's still safe and still available, but actually working for you. I'll give you real scenarios so you can find the one that matches your life. And I'll show you the exact cost in real dollars of getting this wrong. Because once you see it, you'll never look at that comfortable pile of cash the same way again. Let me give you a couple to follow. Call them George and Pat, both 70, recently retired, careful people. They've got about $250,000 sitting in checking and savings at their longtime bank, plus their investments elsewhere. They think that big cash cushion makes them safe. Some of it does. A lot of it is quietly hurting them. Let's figure out where their line is, and yours. Let me start with the side almost nobody wants to hear, because it's the counterintuitive one, the danger of too much cash. To understand it, you have to understand two silent forces working against idle money. The first is inflation. Right now in 2026, inflation is running around 3.5% a year. That means a dollar loses about 3.5 cents of its buying power every year. It's a slow leak, invisible on your bank statement. The number stays the same, so it feels safe, but what that money can actually buy shrinks month after month. Groceries, insurance, the electric bill, a new roof, all creeping up while your cash sits still. Inflation is a tax on cash that nobody sends you a bill for. The second force is opportunity cost, the money you're not earning. And here's where I need to show you real numbers, because they're startling. The big brand name banks, the ones with a branch on every corner, pay an average savings interest rate of about 1/3 of 1%. Not 3%, 1/3 of 1%. So on that $200,000, our careful retiree earns around $750 a year. Meanwhile, a high-yield savings account, just as safe, just as insured, which I'll explain in a minute, pays around 4% right now. On that same $200,000, 4% is $8,000 a year. So she's leaving roughly $7,000 a year on the table every year, just by having her money at the wrong kind of bank. That's not investing. That's not risk. That's the same safe cash in a smarter place. Now let me put the two forces together, because combined they're brutal. Take $100,000 sitting in a typical big bank account. It earns about $380 a year in interest, but inflation eats about $3,500 of its buying power that same year. So in terms of what that money can actually buy, you didn't gain $380, you lost around $3,000 in real value in a single year. Your statement says $100,000. Your grocery card knows the truth. And it compounds. Let me show you what happens over 10 years, because this is the number that should stop you cold. $100,000 left in that big bank account for 10 years, after inflation, will have the buying power of only about $74,000 of today's dollars. You'll have lost roughly $26,000 in purchasing power, more than a quarter of it, while feeling completely safe the entire time. That very same $100,000 in a high-yield account earning 4% would roughly keep pace and hold its real value. And invested in a sensible, balanced way, it could have grown to around 127,000 in real spending power terms. That's the true cost of too much cash. Not a dramatic crash, but a slow, silent erosion of everything you work to build. So that's the too much side. Now let me be just as honest about the other direction, because if you take the wrong lesson from what I just said and dump all your cash into the market, you can hurt yourself even worse. Here's why some cash, a real meaningful amount, is absolutely non-negotiable for a retiree. When you were working, a paycheck came in every 2 weeks, so you never needed a big cushion. But in retirement, that paycheck is gone, and a chunk of your money is invested in the market, which goes up and down. And here's the trap. If you have no cash buffer, and the market drops, and it will at some point, you're forced to sell your investments while they're down, just to pay your bills. That's called selling low, and it's one of the most destructive things that can happen to a retirement. You lock in the loss, and that money is gone forever. It never gets to recover when the market comes back. A cash cushion is what saves you from that. When the market drops, you don't touch your investments at all. You calmly live off your cash and wait for the market to recover, which historically it always has, given time. Your cash buffer is what lets you leave your investments alone in a storm. That is its real job. It's not there to earn you money. It's there to buy you time and to protect you from panic. Let me make that danger concrete, because it's easy to wave past. Imagine a retiree with no cash buffer, fully invested, and the market falls 25%, which happens periodically and always will. She still needs, say, $4,000 this month to live. So she's forced to sell investments that are down 25% to raise that $4,000, meaning she has to sell far more shares than she would have before the drop, locking in the loss permanently, right at the bottom. Do that month after month through a downturn and you can do damage you never fully recover from. Now picture the same woman with 2 years of cash. The market falls and she simply doesn't touch her investments at all. She lives off her cash, sleeps fine, and waits. And history says the market recovers and her shares recover with it untouched. Same crash, same woman, completely different outcome. That is what the cushion buys, and it's why zero is never the answer. That protection is worth more than the interest you give up. So no, the answer is never zero. The answer is enough and no more. So how much is enough? Let me give you the framework the smart retirees use, and it's beautifully simple. You want to hold enough cash to cover your spending for a set period, enough to ride out a bad market without having to sell anything. Here's how to calculate your exact number. First, figure out your monthly spending, what it actually costs you to live. Then subtract the guaranteed income that shows up every month no matter what, your Social Security and any pension. What's left, the part your savings have to cover, is your gap. And the rule of thumb is to keep somewhere between 1 and 2 years of that gap in cash. Let me make it concrete. Say George and Pat spend $5,000 a month, but between Social Security and a small pension, $4,000 of that already comes in guaranteed. So their gap, the part they'd need to pull from savings, is only $1,000 a month, or $12,000 a year, which means their cash cushion doesn't need to be enormous at all. 1 to 2 years of that gap is just $12,000 to $24,000. Add a little extra for emergencies, a new car, a medical bill, a roof, and call it $40,000 or $50,000 in cash. That's their number. Now look back at what they actually had. $250,000 sitting in the bank. They were holding perhaps 5 times more cash than they needed. That extra $200,000 wasn't making them safer. It was just quietly losing value to inflation, year after year, earning next to nothing. This is the single most common cash mistake I see. Good, careful people holding vastly more cash than their real cushion requires, and paying for that comfort with thousands of dollars of lost ground every year. Let me give you a few more scenarios so you can find yourself. Take Ruth, single, living mostly on Social Security, which covers almost all her modest spending. Her gap is small, so her cash cushion can be small too. Maybe $20,000 to $30,000 covers any surprise comfortably. She doesn't need $100,000 in the bank, and holding it would just cost her. Take Bill and Carol, who have a bigger gap. They spend $7,000 a month and only $3,000 is guaranteed, so they pull $4,000 a month, roughly $50,000 a year, from savings. For them, A 1 to 2 year cushion is more like $50,000 to $100,000 in cash. Their right number is genuinely bigger, because their gap is bigger. This is why there's no single dollar figure that fits everyone. It's about your gap, not a magic number. And take someone still nervous who just sleeps better with a bigger cushion. That's okay. If holding 3 years of expenses instead of 2 lets you rest at night, the peace of mind can be worth a little lost interest. I'm not going to shame anyone for that. The mistake isn't holding a cushion you can justify, it's holding 5 or 10 times what you need, out of habit or fear, in an account paying nothing, and never realizing what it's costing you. And let me be genuinely fair here, because there are real situations where holding more cash than the basic rule suggests is the smart, correct move. Not a mistake at all. If you have a large expense you know is coming in the next year or two, a new roof, a car you'll need to replace, a big trip, helping a child with a down payment, a knee replacement, that money should be sitting safely in cash, not invested, because you'll need it too soon to risk it. If you're facing a health situation that could bring big bills, more cash is wisdom, not waste. If you're in the first couple of years of retirement, a bigger buffer can protect you from a bad timing market drop right at the start, which is when it does the most damage. And if a large cushion is genuinely the only thing that lets you sleep at night, that piece has real value. I just ask you to hold it in a high-yield account, so at least it's not losing to the big bank while it comforts you. The rule of 1 to 2 years is a starting point, not a straitjacket. The mistake is never having cash for a reason. The mistake is having a mountain of it for no reason at all, in the worst-paying place, forever. So now you know your cushion number. The natural question is, what about the rest? The money above the cushion. Because for a lot of you, once you set aside your 1 or 2 years of cash, there's still a good chunk left over that's been sitting in the bank. Where should that go? And the answer is the key to this whole video. It should still be safe, still be available, but it should be working, not sleeping. This is where I want to introduce the idea of tiers, or buckets, because it solves the whole puzzle. Think of your money in 3 layers. The first layer is your everyday cash and your cushion, the 1 to 2 years of spending we just calculated. This belongs in the bank, totally liquid, instantly available. But even this should be in a high-yield savings account earning around 4%, not a big bank account earning nothing. Same safety, same access, just the smart version that change alone, for money you were keeping in cash anyway, is free money. The second layer is money you won't need for the next few years but want to keep completely safe, the money above your cushion that you don't want in the stock market. This is where the tools we've talked about on this channel come in. Certificates of deposit, or CDs, which lock in a guaranteed rate around 4% or more. Treasury bills, which are backed by the U.S. government and have the bonus of being exempt from state income tax. And money market accounts. All safe, all insured or government-backed, all paying real interest instead of nothing. You can even build what's called a CD ladder, so portions of it come available at regular intervals. This layer is still safe money, it's just safe money that earns its keep. And the third layer is your long-term money, the money you won't touch for many years, which belongs invested in a sensible, balanced way so it can grow and outpace inflation over time. Because that's the money that has to still be feeding you at 90. Do you see how this solves the problem? You're not being reckless. Every dollar still has a safe home. But instead of one giant pile of cash losing value, you have a cushion for safety, a middle layer earning solid guaranteed returns, and a long-term layer growing for the future. George and Pat keep $50,000 in high-yield cash, move $100,000 into a CD, and Treasury ladder earning 4%, and let the rest stay invested. Overnight, that lazy $200,000 starts pulling its weight. Thousands of dollars a year it simply wasn't earning before, without taking on any real risk at all. Let me show you the 10-year difference in real dollars, because it's the kind of number that changes behavior. Picture 2 identical couples, each with $200,000 of cash beyond what they truly need for a cushion. The first couple does nothing, leaves it in the big bank savings account, earning that 0.33%, the way it's sat for years. The second couple does exactly what we just described. High-yield cash for the cushion, a CD and Treasury ladder for the middle, and the long-term portion sensibly invested. Fast forward 10 years. The first couple's $200,000 has earned almost nothing, And after inflation, it now buys what about $147,000 buys today. They've quietly lost more than $50,000 of purchasing power without a single dramatic moment. The second couple's money, holding its value and growing, is worth dramatically more in real terms, easily $100,000 or more ahead of the first couple. Same starting point, same safety, same people. The only difference was whether the money was allowed to work. That gap, 6 figures over a decade, is the entire price of the too much cash mistake, and almost nobody ever sees the bill. Now, let me speak to why so many good, smart people end up holding way too much cash. Because naming the reason is how you break the habit. For most, it's simple inertia. The money landed in that account years ago, maybe from selling a house or an inheritance, and it just never moved. For others, it's fear of the market after living through a crash. Or two, so cash feels like the only safe harbor. And for many, it's a vague just in case that never gets a number attached to it. Here's the fix for all three. Give your cushion an actual number the way we just did, spending minus guaranteed income, times 12 or 24. Once the safety job has a defined dollar amount, the rest of the pile loses its excuse. You're not being reckless by moving it. You've already fully funded safety. You're just refusing to pay for it 5 times over. And moving money is far easier than people fear. Opening a high-yield savings account online takes about 15 minutes. It's FDIC insured exactly like your old bank, and you can link it to your checking so transfers take a day or two. The hassle is tiny. The payoff is thousands of dollars a year. Now, an important word for those of you who do keep a large amount in the bank, whether by choice or because you're in the middle of moving it, you need to make sure it's actually insured, because this trips people up. That government deposit insurance, the FDIC, covers you up to $250,000 per person per bank. So if you've got more than that at a single bank in a single name, the amount over the limit isn't protected if that bank fails. But the fix is simple and worth knowing. The limit is per person and per ownership category, and those stack. At one bank, a husband can be insured for $250,000 in his name, the wife for $250,000 in hers, and a joint account for another $500,000. So a couple can have a full $1 million insured at a single bank, just by titling the accounts correctly. And one quick caution: a money market deposit account at a bank is FDIC insured, but a money market fund at a brokerage is not. It's very safe, but it doesn't carry that government guarantee. So know which one you have. Let me pause and be honest and careful with you the way I always try to be. Everything I've said about too much cash assumes you have investments and income beyond it. If your entire life savings is small, and it's all you have, then holding it safely in the bank may be exactly right for you. And there's no shame in that whatsoever. Capital preservation matters more than yield when the money is all you've got. The too much cash mistake is really aimed at people holding far more cash than their cushion needs, while the rest could be working. And these interest rates I've quoted, the 4s, the low percentages, they float up and down over time, so check today's actual numbers when you act. But here's the part that doesn't change. The giant brand name banks will almost always pay you dramatically less than a high-yield account, a CD, or a Treasury. That gap is the constant, and inflation, though it rises and falls, is almost always chewing away at idle cash. So the principle holds, even when the exact numbers move. And I'd add, right-sizing your cash and setting up those layers is a great thing to talk through with a fee-only financial advisor. One who charges a flat fee and doesn't earn commissions selling you products, especially to make sure your cushion truly fits your spending and your nerves. This is not about chasing risk. It's about not paying year after year for safety you already have twice over. Before I bring it home, let me name the 4 cash mistakes to steer around, because avoiding them is most of the battle. Mistake 1. Keeping your cushion at a big brand name bank, earning 1/3% when a high-yield account pays 10 times more with identical safety. That one's just free money you're skipping. Mistake 2. Holding 5 or 10 times more cash than your cushion needs, letting inflation quietly eat it. Mistake 3. The opposite error. Holding almost no cash, so the next market dip forces you to sell your investments at a loss to pay the light bill. And mistake 4. Keeping more than $250,000 in one name at one bank without checking that it's fully insured. Steer around those 4, and you've handled 90% of this topic. Now let me help you find yourself quickly so you know your next move. If you've got a big pile of cash at a big bank earning nothing, your move is to name your real cushion, move that cushion to a high-yield account, and put the rest to work in CDs, treasuries, and investments. If you're the nervous type sitting on 3 or 4 years of expenses in cash, that's okay. Just get it into a high-yield account so it stops bleeding to the big bank. If you've got barely any cash and you're fully invested, your move is the opposite. Build up that 1 to 2 year cushion so you're never forced to sell low. And if you have a big expense coming in the next year or two, carve that money out into safe cash now, on purpose, and don't feel one bit guilty about it. Find yourself in one of those, and you know exactly what to do Monday morning. So let me bring it home. We started with that careful retiree and her $200,000 in the bank, feeling perfectly safe. And now you understand the quiet truth. Some of that cash was doing an essential job protecting her from ever having to sell in a downturn. But most of it was just sitting there losing thousands of dollars of buying power every year, disguised as prudence. Too little cash is a loud, dramatic mistake. Too much cash is a silent, comfortable one. And because it feels so responsible, it can go on for years, costing you the whole time. The goal was never to have the biggest pile of cash in the bank. The goal is to have exactly enough that a bad market never frightens you, enough that any surprise is covered, enough to sleep soundly, and then to let every dollar beyond that enough go to work for you, safely, so it holds its value and grows instead of quietly shrinking. That's the sweet spot. Enough, and no more. So here's what I'd like you to do this week. Take 10 minutes and figure out your gap, your monthly spending minus your guaranteed income. Multiply it by 12 or 24, and that's roughly your cushion, the cash that truly belongs in the bank. Then look at what you actually have sitting there. If it's a lot more than your cushion, you've just found money. Money that's been quietly losing ground, that you can put to work, safely, starting now. Move your cushion to a high-yield account, ladder the next layer into CDs and treasuries, and let the rest keep growing. Same safety, same peace of mind. But now your money is working as hard as you did to earn it, instead of sitting still while the years and inflation quietly carry it away.